Now we're in the second half of this panel on electricity. We're going to talk about transmission. I realize in letting the panelists introduce themselves, I failed to introduce myself. So let me just let me say I'm Chris Woodruff. I'm a professor at Oxford. I'm also the scientific coordinator of PEDAL, so one of the sponsors of today's program. And then I sit on the board of BII as chair of the Development Impact Committee as well. So I'm also connected to BII as well. So with that in mind, we have one academic and three CEOs of transmission-related companies with us today. So we're going to start with Nick Ryan from Yale, and I'll let you introduce yourself further, and then we'll go down the line from there.
Great, wonderful. So I'm Nick Ryan. I'm an energy economist, associate professor of economics at Yale University. I mainly study energy markets and environmental regulation around the world, but especially in India and rapidly growing countries. So I'm going to sort of start as the lone academic here, very sort of zoomed out at a high level. What is the problem statement and what could impact investing do? What could it contribute? And even is it needed? Because the private sector is kind of taking off and investing a lot in renewable energy. So you could come back and question, okay, why is public money needed? What does social investing do? And so at a very high level, there's sort of two problems that economists see. One is that energy does not reflect its social cost in its price. So you have just the wrong price for all kinds of energy sources. That includes both sort of greenhouse gas emissions, which are not priced in most of the world, as well as local air pollution. So, in New Delhi today, the AQI is something like 360. That's another externality that is not in the price of coal energy. So that's the first problem. The second problem is innovation is undervalued in the marketplace. Because if I innovate, if I build a new technology, or even if I build a new project, I make a new type of deal, which is another kind of innovation, and that's the first in its market, that serves as a proof of concept. And everybody else can see that, and everybody else can copy my deal. And so I'm not going to get the entire social value of having struck that deal because of this kind of dynamic of learning and mimicry. And so these are the sort of two problems. And the key thing here, if you come back to what can impact investing do, is that those two problems are still here. So what is happening in the sort of electrify everything and clean the grid space is there's been massive technical change. So the cost of an installed unit of solar PV from 2010 to 2020 fell by roughly 5x, which is just a miracle. It's incredible. It's the greatest technical change of our time. And we're still going to be benefiting from that for a generation or more to come. That means that the private market has moved. That is, the private cost of solar generation is much lower. Similarly, for wind, there have been lesser gains, but still quite dramatic. It does not mean that the first two problems I identified have gone away. So it's still the case that energy is mispriced. It's just mispriced, and there's now a lower cost of clean energy. The price of the dirty energy is still wrong. So there's no reason to think that the market is going to get this right. Nor has the innovation sort of externality, that is the benefit of making sort of new and innovative deals, diminished. In fact, if anything, because the cost of green energy is now so much lower, that arguably innovation and the learning benefit of striking a new deal or making a new transmission investment or deriving a new way of trading energy that will enable this clean energy to be efficiently used, the value of that might have gone up. So the fact that the private market is booming because of this cost decline does not undercut, in fact, might even strengthen the need for social investments here. And so it does mean you have to justify, okay, what business should be, we be in, should BII be in? What are the sectors where we think that these kind of unpriced externalities, the gap between the social and the private cost of the deal might be large, or where the benefit of a deal is especially valuable for society by setting a precedent, by pushing a regulation. You have to look for those things. But it doesn't mean that there's no case for social investment. And then, with this as backdrop, I just want to mention two of the problems I've been working on. and how they reflect this kind of change in renewable energy getting cheaper and then putting pressure on existing institutions. So what happens is, the technology changes, and then all of us are sort of downstream. You have your phone in your pocket. It's like Apple makes the world, and then we're just living in it. Same thing for energy. Technology changes, costs change, and then regulators, grid investors, everybody sort of reacts, and that takes a long time. So how does that play out for renewable energy? I'll give you, 2 examples. One is, in a new technology, you have a lot of risk. People have to, make a leap of faith, and that risk means that there's a big concern of counterparties. I don't want to get caught out. I don't want to invest at the wrong time or at the wrong price or with the wrong duration when this technology is changing. And that's especially so, and we've heard a few times today, when there are long-term contracts for clean energy. Why would I lock in for 20 years? It's getting cheaper all the time. I should wait. And so there's a counterparty risk here, which is you're going to be selling to a utility. That utility is very skeptical that you as a clean energy developer are the right deal for them. And you as a developer are skeptical that the utility is going to honor the contract. We just heard that all the utilities in low-income countries are under a lot of fiscal stress. They're nearly bankrupt. And so what can you do? Well, in that situation, there have been different instruments to try to offer payment security or guarantees against the non-payment from these unreliable discoms. So I have one paper which is studying the efficacy of these guarantees in India, offered by a government corporation called SECI, the Solar Energy Corporation of India. Basically what SECI did is they said, look, we know that many of these discoms are in a bad way, and so you as renewable energy developers might not want to sell to them. Therefore, we are going to basically serve as the grown-ups in the room. We're going to basically act like the parents of the states. When their young children go off after university and try to get their first flat, you might have to co-sign for that. So the government of India has co-signed for tens of gigawatts of solar capacity all over the country. And what's kind of interesting is that these projects, the SECI-sponsored projects, they're going up side by side with projects that are run by the states themselves, like literally in the same districts connected to the same grid. So you can look at these projects, and what you see quite systematically, and I estimate this in the paper, is that the SECI projects get a big discount. And that discount depends on how risky is the state. So if you're investing in Gujarat, which has a good reputation as a payer, there's basically no discount at all. It's the same conditions. It's at parity. If you're investing in Odisha, in Bihar, in UP, then the discount is quite large. It could be 15%. It could be 20%. And that's because the investors know if I pay to this utility, to the state directly, as opposed to SECI, there's some chance I'm not going to get my money back. If I have this backed contract, then that will be a much higher return. So that's one example from my research of illustrating these principles.
Great. Thanks, Nick. We'll come back. There's some things on that, but Satish, so I should say now we've got three BI investees, and I have to say 3 of my favorite investments. These are all going to be great stories. So with that, no pressure. But Satish, tell us about Energrid.
Presentation, it will become more favorite. Okay, so great, and thank you for having me here. Thanks. It's a great forum. All academics and practical realities are being discussed. So thank you. So let me just introduce first of all about myself. I am in the industry for last 27 years. Majority of it was in gas-based combined cycle power plants, wind. Now, of late last 8 years, I am working in transmission, solar, and battery storage. So primarily into Larsen & Toubro. I worked with GE for long 14 years, and the last 7 years I am associated with IndiGrid and now Energrid. About the company, just before that, I think Samir has already given some context, but we are trying to solve problem between generation and the distribution. So we are largely into power transmission, 80% of our business in transmission. Of late, then we diversified into solar generation, and then recently we became one of the largest developer of battery storage system in India. So let me, how it works.
Go. Yeah.
Okay. So just to give you some snapshot how India is doing in terms of power transmission and battery storage. So this next 5 to 8 years or 10 years, I can see personally a unprecedented growth which is coming out because of energy transition needs, largely driven by per capita consumption, which is increasing at least at a CAGR of 7 to 8%. And of course, EV adoption, data center, AI, that is going to, command the growth of the sector. So as you can see, just in next 3 to 4 years, the transmission capacity is going to go up by sheer 500,000 kilometers to almost 650,000 kilometers. This calls for an investment of almost $110 billion. And you can see the blue and the green one. The blue one is at a central level, we call it interstate. And the green one is at a state level, which is driven by state utility bodies. So next, so this is on battery storage. By 2032, we want to put 47 gigawatt capacity, which means almost close to 250 gigawatt hour of operating capacity. So this is all planned by National Electricity Plan and by various forum of the committees. And because of this, we thought, I think, let's play in the market, which can help to unlock the value of asset through an asset monetization platform called IndiGrid. So IndiGrid was set up in 2016, got listed in 2017, and it's India's first power sector investment infrastructure trust. It's very similar to ILCO model, what we see generally in a global market. And the purpose of this platform is to create a predictable cash flow through an asset monetization mechanism for long-term nature of contracts. So all our contracts are for 35 years to 25 years, depending on the asset what we have. So it has a portfolio of almost close to $3.7 billion asset under management, operating. As you can see, it's a diverse from north to south and east to west, with almost 9,000 circuit kilometers and growing every year phenomenally. And now to capture the growth of this platform, because as a InvIT, we could not able to build our own assets. So what IndiGrid does is raise the capital to acquire the operating assets and then manage it for 35 years. That's how the asset monetization works. So in order to create our own pipeline, we came out with a platform called EnerGrid, which is a development company platform. And as a part of arrangement, EnerGrid will build the asset and eventually will give it to IndiGrid to maintain it. And that's where we wanted, so there is an unprecedented opportunity, and that cannot happen without the ease of capital commitment. That's where BI and Norfund came together, helping us to build this platform. Each of them have committed 100 million equity, and already 50% of that is deployed. So again, the focus is on large-scale power transmission projects and utility-scale battery storage, and also related solar projects which are connected to this system. Yeah, next. So this is what, where are we today? So we started in November 24, and within span of almost a year now, we hit the number of almost 700 million with 9 projects in hand. And then our mission is to reach almost $1.4 billion by end of 26. These are the 9 projects. As you can see, we started now grabbing all the critical infrastructure projects in the country, both for transmission and battery storage. And this is putting us a one of the favorable platform for the development need of the country. Just to give you landscape, in India, there are 4-5 players who is dominating the market in transmission. The largest is Power Grid, which is like having 80% of the market share. And apart from us, Adani, Sterlite, and even Aparva kind of a companies are there who are into this segment. And in battery storage is something which is happening crazy right now. For one tender, there are more than 20 to 50 bidders which are playing in the market. So that's a portfolio, and the kind of introduction wanted to say. These are just a glimpse of projects, what we are trying to do. Yeah.
Great, thanks. Next, Chris will.
Thank you, Chris. Just wait for the slides. I've only got 4 or 5 slides. I just want to introduce GridWorks pretty quickly. But then I really liked the problem statement at the start. So I wanted to sort of link it back to that and provide some context for where we do business, which is Africa. So GridWorks was set up by BII in 2019. And it was set up as a specialist investment platform in transmission, distribution, and distributed renewable energy. And when we set the platform up, we recognised that in this space in Africa, there'd been a lot of investment in generation to date. BI had recently brought Globalac back in-house as a direct portfolio company again. And there was a recognition that there was a lot of capital available for the generation sector, but that transmission and distribution were now a great bottleneck to unlock generation projects, but in terms of economic development as well. So that was the starting point. And we knew we'd have to take a lot of development risk in that context because there weren't very many ready-made projects on the continent. I think we expected that we'd be able to fund other people's development risk and back teams on the continent. What's happened over the last 6 years is that we've realised that we'll actually have to do a lot of that development ourselves. So that's been the reality for us. So, looking at where the sector was in 2019, almost all investment in T&D infrastructure in Africa is state-backed. It's funded using government tax receipts, but more commonly using loans from multilaterals or increasingly export credit agencies. And this is problematic. It's problematic for a couple of reasons. One is that most African governments are operating up or around the debt to GDP sort of caps with the IMF. So there's a practical limit to how much infrastructure they can fund this way. And it's been particularly acute since the pandemic. The other is that these models, although they're appropriate for some projects, particularly the multilateral models, there are some major inefficiencies. So in the context of the multilaterals, it's around time for projects. We're aware of lots of T&D projects on the continent where there's been very significant fiscal challenges because the projects have been delayed. The very famous one is the Lake Turkana project in Kenya, where a very significant wind project was stalled for a very long period of time, waiting for multilateral funding for the projects. But there's lots of others. There's a hydro project in Uganda where the government, the Ministry of Finance, has now made so much payment in deemed energy whilst waiting for a loan from a multilateral that had issues in relation to it. So procurement periods for multilaterals and uncertainty around those processes can cause significant problems as well in the sequencing of infrastructure. And then in the context of export credit agencies, that often looks like very cheap financing, but it's usually tied to a particular construction provider. And the construction margins can be quite significant. And the piece of research that we often share with governments in relation to this is a piece of work done by the World Bank in the context of private investment in transmission in Peru, where the budgeted prices for the transmission lines with more expensive private capital actually ended up being around 40% cheaper as a result of disaggregating the financing from the construction solution, which is tremendously interesting. So in this environment, GridWorks is investing in transmission projects. We are developing them directly ourselves using our team. We are backing distribution projects as well, developing one and via one of our portfolio companies, Anzana Electric. And we're also investing in distributed renewable energy, and that's principally solar and storage to commercial industrial customers via one of our portfolio companies, Sustainable Power Solutions. Now back to the problem statement. I think it was a couple of bits. Well, I'll pick the ones I like anyway. The first one is the sort of the broken relationship between the benefits of having electricity and the cost of providing it. And I think in the previous part of this panel, there was discussion around metering strategies to improve the economics of distribution companies in particular, which is tremendously important. Distribution losses are enormous in almost all African utilities. But even more fundamental than that, I think, is the relationship between tariffs and utility financial health as well. I think your quote Chris, 51 from 54 companies?
Yeah.
I think that probably just matches which countries have cost-reflective tariffs. Because you can be as efficient an operator as you like, but if you are fundamentally charging tariffs that don't reflect the cost of operating the network, of maintaining the network, of building the infrastructure, then most infrastructure that you can build is going to become loss-making infrastructure. And then everything is related. Your collection losses will go down because you can't operate efficiently, because you're constantly losing money and you're making do and mending. So that's a particular challenge. And we've got a couple of strategies for dealing with that. One is that we're very careful about which projects we do. Even in an environment where tariffs aren't cost reflective, there are often projects which we would describe as commercially accretive. Because if you build that project, you actually improve the finances of the utility to an extent. And the best example I can provide for that is a project that we're in the process of closing in Uganda at the moment called Amari. And that project is working in an environment where there is more generation than can be efficiently evacuated at the moment, provided to end users. And we know that there is unmet industrial demand near some substations. So we're privately financing those substations with the government in order to take that generation that's already paid for and deliver it to end users. And our financial modelling of that project shows that the government or the utility has $50 to $60 million more per year as soon as that infrastructure is commissioned, versus the case where they've over-contracted the generation, but they're not efficiently evacuating it yet. And the other strategy we have for dealing with, the other two strategies we have for dealing with this environment are, in the case of distribution projects and distributed renewable energy, it's selling directly to the end user and going around the utility to an extent, or creating a new utility. Obviously, metering is tremendously important to that, and metering strategy in an environment where consumption can be very low is tremendously important to that, getting that right. There's a limit to what you can pay for a meter per household if the meters are consuming very small amounts of power. And then lastly, almost all of our projects, Amari is probably the exception, involve very significant sums of concessionary capital. So I think back to your point about social investment. I mean, the utility sector is always subsidised everywhere in the world. Grid extension programs in Western countries are largely subsidised. Most PPPs in most infrastructure asset classes all over the world are subsidised, either directly into the project or through some subsidy elsewhere in the sector. The big challenge with doing this in the African context is that governments don't have the fiscal capacity to provide that subsidy most of the time. So it has to come from somewhere else. It can either come from multilaterals providing direct grants to projects, or you have to do it in a much more entrepreneurial fashion as a developer and raise pots of grant funding from other types of organisations like philanthropies, often from governments in their capacity as donors, or looking for some content for their manufacturers in the project. So an example, to give you a couple of examples, the transmission project we're developing in Mozambique at the moment is called Chimura Nakala. It's roughly a $500 million project. It's the main transmission spine in Mozambique. It's actually the first example of such a critical project of the transmission spine in a country in Africa being allocated to the private sector. But in order to do that at a cost that can be absorbed locally, that doesn't blow up the local utility tariff, we're required to raise a lot of grant funding and a lot of concessionary capital as well. So of that $500 million at the moment, we're in the process of closing out a $75 million grant from the Dutch government, and another sort of $30 to $40 million from other donors, mostly multilaterals as well. So this is helpful. This brings down the cost of the project. But it takes a lot of time. It takes a lot of time to do this. We're fundraising for project development because it costs, sort of, let's say, $20 to $25 million to develop a project like this through to financial close. We're fundraising a lot of that money because the development risk is very high. As you said, because doing first-time projects, obviously, a lot of the time, the projects can't carry the risk and the time period involved in doing them. They're very important as a precedent, but we have to find social investment to defray the development risk, or nobody will do them. We're then fundraising for the viability gap funding, and finally, we're fundraising from a collection of lenders to provide the senior debt for the project as well. So these are long-term projects that take a long period of time. They The technology is very simple. So if we're discussing this in a climate tech conference, it's really quite old technology most of the time, particularly for transmission. But the innovation is taking business models that have been used very successfully, including in India, elsewhere in the world, ITP structures for transmission, for example, and managing to fit them into a very specific context in Africa, where you have challenges around needing products, multilateral support for offtake to make local utilities creditworthy, where you need to raise viability gap funding from a number of sources as well. So that's the sort of unusual bit in what we're doing relative to other markets.
That's great. Thanks, Chris. And Evan, to you.
Thanks. And I'm going to, as a reforming former consultant, I'm going to spare you any slides if I do this. So firstly, thanks so much for the opportunity to join the panel and to bring me over here to share a bit of our story with you. My name's Evan Rice. I'm the CEO at Etana Energy. We are a licensed energy trader in South Africa. We don't yet have a market in South Africa, so we're not really doing trading in the sense of how people typically think of electricity markets and trading today. It's more we're an aggregator, and what the problem we're, I guess, trying to solve in South Africa is trying to bridge the gap between what financiers and in particular lenders need in terms of an off-taker, a credible off-taker long-term so they can issue long-term debt and deliver energy projects at a good price, and what customers are willing to commit to on the other side of the transaction. And just to paint a little bit of the context, I guess, for where South Africa's at, actually got a pretty well-developed electricity infrastructure in the country, that over the last decade and a half, we've had a pretty bumpy ride, including periods where we're getting 8 hours a day of power cuts, declining performance in the generation fleet from the state-owned utility. There's been a lot more customers connected to the grid, been a very positive story in the country, but a very ambitious new generation build program from a utility that hadn't built for a while, with mega projects that didn't go well and have basically left the utility in the same shape as many other utilities on the continent now. Very poor balance sheet, couldn't raise sufficient, had to move funding from maintaining plants to finishing off the plants that are delayed, that they're trying to construct. And we've ended up with electricity tariffs that have increased in real terms 350, 400% in the last 10, 15 years. We went from a very low-cost electricity system, powering an industrial base in South Africa, mining companies, etc., to middle-cost electricity country, putting real strain on some of our key economic sectors, and massive reliability problems in the grid, causing further knock-on consequences for the economy. Over the same period, obviously, we've had this rapid decline in new technology costs from renewables, driven by the investments in scaling it up globally, and a very successful program that was run by government procuring renewables, although those early rounds were at subsidized prices, which further increased tariffs in the country. But obviously, over the last 3 or 4 years, we've reached the point now where the cost of new wind and solar is not only the cheapest form of new generation, but it's actually can be built below the average cost of electricity tariffs in the country today. So we're in a favorable technology cost environment. There's lots of capital super interested in deploying investments into this infrastructure. We've got 50 to 60-year-old coal plants that need to be retired, and most of that is going to get replaced by wind, solar, and batteries. But the utility's effectively bankrupt. The procurement program has been backed by sovereign guarantees. Treasury's run up against its limits, and we've got to find new ways to effectively finance this infrastructure. So what's happened very rapidly in South Africa over the last few years is initially some of the biggest mining houses and big industrial companies that use a third to 40% of the electricity in the country signed bilateral agreements that relax some regulations around who could build, as long as you had someone who's willing to buy and you could connect to the grid. We had a lot of bilateral deals, maybe 20 or 30 renewable projects have been built or in the process of being built, a few gigawatts of new capacity. And very quickly we hit limits where those companies saying, I don't want to sign a 20-year PPA, take or pay PPA. I'm not sure we're going to be able to use all of that over this time. There's grid risk I don't really want to take. We've done our piece, but we need a new model. And so that's effectively what we are trying to do, is bridge that mismatch in risk requirements and appetite from the lenders and the consumers by building a portfolio of wind, solar, hydro plants, selling that to customers in packages that meet their needs and their risk appetite, slightly shorter durations. The big challenge that we had, and this is the link, I guess, to BII and why we're in the room today, is as a newco, we're not really bankable, even though we've got strong investors with big portfolios of renewable projects that they very successfully developed, financed, and are operating in the country. They're not liquid. And we had to put together a guarantee instrument, payment guarantees to back our obligations, to give the lenders comfort that they could sell to us. And we worked for a couple of years with BII and Garanco, and ultimately with one of the commercial banks in South Africa to put together a credit support facility that enables us to enter into these long-term contracts so that we can use the existing grid infrastructure, build big projects in the places where they're going to deliver the lowest cost of supply. Everyone pays to use the grid via use of system charges or wheeling, but we're able to take effectively that burden off the utility and National Treasury in terms of having to backstop these purchase commitments, and we're using the private sector balance sheet instead to get the financing done. And really excitedly, I have to shout out. We had a bit of a late night and early morning this morning and getting some guarantees issued, but we took our first two wind projects, 190 megawatts of wind, to financial close this morning.
Fantastic.
Yeah.
Yeah. That's worth it. Can I ask just a follow up before I jump in with broader questions? On the customer side, are these customers who are taking everything from you, or are they also are you sort of supplying power during the day when the wind is blowing, and then they're on the grid the rest of the time? How does the customer side work?
Yeah, so we don't have retail competition in South Africa yet. There isn't a market, so we can't procure 100% of the power and guarantee it. So they remain customers of the distribution utilities.
I see.
But we supply them up to, in our case, 70% of their annual demand from this portfolio of wind, solar, and hydro.
Okay.
And the balance they get from the grid operator, effectively it's an accounting transaction. Right? At the end of every month, we say, here's what went in from our generators' meters. We allocate that across customer accounts. They get a discount on their bill from the utility, and they continue to pay the grid charges and the residual energy that's not supplied by us to the utility.
So what they're getting then is lower prices from you. They're not, because then they're not getting more reliability in a way. If the residual is the grid, they're not getting.
Correct. We are not providing any additional reliability directly, but what we're doing is help finance the additional generation that is helping the entire system become more stable. What they're getting from us is they're getting certified clean electricity at a discount to the grid today, and with price certainty, inflationary increases over the life of their contract, rather than way above inflation historically in tariffs for the last 15 years.
Right. Okay. Great. Let me step back, and Nick, I'll say jump in anytime you want. But let me step back, Satish and Chris. Satish, we talked this morning about the process of building a new transmission line in India, 24 to 36 months, and some certainty on that end. Chris, I'm assuming it's not always 36 months at the long end in Africa. I'm kind of curious, what is the process in both India and in Africa in your experience, in terms of from start to finish? What are the bottlenecks, and what's the difficulty in siting a transmission line?
Okay. So I think 24, 36 month has been evolved, I think, over last 15 years. Earlier it used to take 48 months to 60 months for complete construction. But I think few developers have really leveraged the technology and very efficient way of managing administrative process. So one of the biggest challenge for transmission line is land acquisition, followed by right of way. Means you have to get access, right to use the land underneath transmission corridor. So typically land acquisition can take any time between minimum 6 months to 2 years. So how smartly you manage that entire process is something art which we have developed now, and of course with the support from government and very good focus from central ministry, because we typically deal with central projects. So there is a lot of push from Prime Minister's office to make sure that these projects are critical, essential infrastructure, and there is good amount of support we get from all the departments, whether it is forest, land, revenue, or any, say for example, line is crossing through railway. So all that support comes in. So land and ROW is a partner, but still there are few challenges like central always, like Samira said, issues the policies and guidelines, but there is always a lag on implementation by the states. So that gap creates a lot of issues in arriving at a consensus. How do we speed up further in terms of acquisition? Second challenge, what we are seeing is bit of clearances on environmental side. I think the forest is one biggest elephant. If it comes in mid of transmission line, that might take minimum 8 months to 2 years kind of a time frame. And that's where we get 36 months of schedule in those projects. Apart from these two, I think there are a lot of technology means which are available now, wherein we can do faster installation, deployment of crew, resources, and then we can make the project in time. Of course, resources have of late becoming challenging. The availability of laborers and the deployment of them at the right time, right place is always a challenge. So that is also another thing which we'll have to work to achieve that schedule.
Mm-hmm. For context and statistics, in India, are all of your projects tendered by a transmission system operator who's planned the network? Correct. So you win the tender, and at that point in time, there will be a detailed feasibility study?
Not detailed, high level.
High level feasibility, some scope of designs for the purpose of the tender, but then you'll do detailed designs.
Correct.
And do you select your own routes, or do they give you the route that they would like for the land acquisition?
So they will give the boundary conditions of the route.
Yeah.
That certain span of, so point A and point B is typically fixed.
Yeah.
And in between, you can decide multiple route options, but there is a limitation from where you can go.
And the contracts you use are part of the tender process. So you start with a set of contracts and there's firm regulation.
Yes.
Correct. Yeah, okay. So for context, in most African markets, the projects we're doing are the first transmission projects on the continent. No one has ever done them before. What you do have in most countries in Africa is an Energy Act and some PPP legislation that is permissive of private investment in transmission, mostly because that sort of legislation was cut and paste stuff from World Bank programs a decade or two ago. Yeah. But to give you an example, in Uganda, we signed an MOU with the government in June 2022 or 23, 22, I think, 22. To do the first ITP. And we started work with just an MOU and a project selected. We had to use the project as a pilot for the first transmission regulations in the country. We wouldn't have had to, we could have done it with the existing framework, but the World Bank became involved and was very keen to run this through a process with advisors to create a set of regulations. So we had to redo all the feasibility. We had to rescope the project twice and redo the feasibility. We had to help create the regulations in the country, and we drafted contracts from scratch and then negotiated them with the regulator, the Ministry of Finance, the Ministry of Energy, and the transmission utility, and the Solicitor General, over a period of what is now 3 to 3.5 years. We will close the project quite early in the new year. We're lining up the signing of the contracts at the moment. But that piece of work on the front end is back to the point around doing these precedent projects and the benefit of them. I think a lesson we've learned from Uganda is that will only, because it's been rescoped and descoped a couple of times, that will only be a roughly $60 million investment. And a lesson for us as an organisation is that if you're going to do a first-time project, you want it to be about 10 times that size, right? Because the efforts involved in all that early stage work, it can be paid for by a very large project. It can't be paid for by a very small project. So the process, at the point you pick the project up following a tender process, we are probably doing 2 to 3 years work on the front end first. And but I mean, the challenges around land acquisition, we have very similar challenges. And they vary from market to market. We will have to move thousands of people in Mozambique and build them new homes as the line comes through the areas where they live at the moment, and those challenges are common.
Yeah. If I'm not wrong, we were in same boat like before 2010.
Okay.
But of late, the process has become very standardized. There is a standard bidding document where Central Transmission Utility and Central Electricity Authority puts that much amount of effort in planning the network and do high-level feasibility and service study. Yeah. Because when the RFP is out, the request for proposal, that is common level playing field for all the developers. So there we can't have ambiguity, because otherwise the tariff-based competitive bidding will not work, right? The scope has to be firmed up. So that's a evolution which happened over multiple years in India.
Right, so that's what I was going to follow up with, Chris, is how much of what you described as a first of a kind, and even the next time it'll be simpler, or is this a process that's going to take several iterations within a two-part question, within a government, and then how much will this spill over because you've been successful one place, that you're able to sort of either what you've learned or what you're able to sort of talk to the government about will be easier in a different country?
So I think probably the smartest thing you can do if you've just done the first transmission project in a country is do the second one. Yeah. Because not only have you created all of those processes and tested them for the first time, and just simple things like which order those government agencies approve things in matters, and they have views on them, and they won't give you their view until they're forced to confront it a lot of the time. So I think you've got the contracts, you've got the government relationships, and normally you've then got a team who has the relationships in market as well. So I think the second project in a market should be a lot faster than the first one as a result. But then regionally, I think there are improvements as well. Now, one of the great challenges in Africa is you've got lots of relatively small markets. You can't do 6 or 7 large-scale ITPs in Uganda or Mozambique the way you can in India. So there are challenges there. But all these regulators do speak to each other. All of the advisors and the DFI lenders and the viability gap providers and the multilaterals, those are a lot of the same people. So they learn from process to process as well. They refine their thinking. We had a greater degree of certainty going and talking to lenders in Mozambique after educating them about the project in Uganda. It was a lot of the same organizations. There was a piece of work that was paid for by USAID when it still existed about 4 or 5 years ago. One of your colleagues, Jay, was involved in it. And so I worked with Jay and a few other people, and we wrote a book about how to project finance transmission infrastructure in Africa. That was actually hugely helpful. It's a wonderful thing that USAID did by making us do that, because when you go round from market to market, sitting with a regulator to talk about it for the first time, everyone's got a well-thumbed copy. If not the first time you meet them, the second or the third time. So I think there are efficiencies here, but it'll always be more challenging in a collection of smaller markets than in one large market.
Great. So if Evan, let me come back to you a second. So what you described is, I guess it's a change in the law that allowed wheeling between private parties on the system. Is this a step in the direction of sort of a more open sort of private market for electricity? Or is it how what do you see? If this is successful, what's the follow-on from it in terms of policy and the way the market develops?
Yeah, so Chris, it's actually not a change in legislation or policy or regulation around wheeling. That's actually been allowed in the country for 15, 20 years. It's just never been economic to build new generation to compete with all these amortized coal plants. And so that was the good fortune that we kind of fell into here, is we actually had an established framework with use of system charges that were regulated. And suddenly the technology cost got to the point that you could actually build a business doing this. Previously, there had been some captive generation plants selling some excess at certain times of the year to other facilities within the same group, or there was a single trader or trading license that was issued in 2009 almost as a pilot, but the model was not economically viable to scale with new generation. So that's been good. What really unlocked it was previously it was a central planning model. You couldn't build a generator of more than 1 megawatt without ministerial approval. It had to be in line with the integrated resource plan. And that got taken away. Business said, guys, we can help fund these things, but remove that limit, then upped it to 100 megawatts and then took it away altogether. And that really catalyzed the investment.
So when did that happen?
Probably about 3.5, 4 years ago.
Okay.
So just to pick up on that, I'm curious because I see this, all the assets you all are talking about are sort of downstream of energy markets for electricity. They create value because they're connecting, people who need electricity to suppliers. But a lot of the in-between, where that value sort of gets, squeezed, sometimes passes through very incomplete markets, or markets where prices are regulated, markets where prices might be capped at certain times of day, or where the wheeling charges are not reflective of, costs of building that infrastructure. So just to give a sort of trivial example, like in the US, there are nodal prices for electricity. They're very finely resolved, and you have financial contracts that are based upon the differences between these prices. It's very easy to see where the highest value assets should go, whereas in the environments that people have described here, those highest value assets are sort of being dictated by a plan. It's not obvious that those are the best places. Of course, you're not necessarily bearing that risk, therefore, but I wonder, are there examples? Another would be like battery storage. If price arbitrage is capped because the wholesale market is sort of capped at a maximal price, which is common. Regulators want to show low prices. That obviously suppresses entry into that business. So are there examples where energy market regulation is inhibiting investments that you think otherwise ought to happen, that you see as valuable for the system, but which have been kind of squeezed on these margins?
Yeah, so Nick, maybe I'll just pick up on two threads here and kind of link this a little bit back to the transmission theme as well. But let me first start with the other side of this, which is what we are to answer Chris's question explicitly, a liberalization process is now firmly underway, clear policy direction, legislation has been amended that's forcing the utility to break up into its constituent parts, part of the same group, still full state ownership, but they will be establishing an independent transmission operator to try and remove the inherent conflicts of interest and allow private capital to come in and feel like there's at least some kind of a level playing field. So that is coming.
It's going to be 3 companies. It'll be generation, transmission, distribution, or
yes, and they're going to separate distribution out into wires and trading as well.
Okay.
So effectively, I'll be competing against Eskom distribution company and municipalities, although they will be the supplier of last resort until we get to full retail competition, which may happen in 10 years' time.
And
it's
then
going to be a journey.
You use their lines, basically.
And then we pay to use the lines, exactly. Right. So that process is now firmly underway. And part of the reason for doing this is actually, the grid is going, or our generation mix is undergoing this radical transformation from big centralized coal located largely in the northeast of the country to wind and solar, which is largely in the western half of the country and now going everywhere, wherever grid is still available. Right? But there's a massive grid build-out that's got to happen in South Africa. And the strategic decision has been that Treasury guarantees and support for what is a natural monopoly, being the grid, will be directed there on a PPP program. ITP is being launched there to fund the grid infrastructure to allow private investors to continue to invest in generation in the places where it makes most sense.
Right. Can I come in this briefly?
Yeah.
So I think I think the start of the question was about the sort of regulatory, legal infrastructure and then market design. I think what Evan's describing here is a risk that the liberalisation of the market is running well ahead of the actual physical infrastructure. And there are examples of that happening in other markets, and it doesn't end very well, right? And when you look at a lot of Southern Africa at the moment with SAP, with the Southern African Power Pool, this is a very nascent market. It's quite an interesting, exciting market, but it's not. Probably market's the wrong word, but it doesn't really work as advertised. The regulations don't really work. There's lots of reasons for that, but one of them is that there are transmission constraints all over Southern Africa. And with most of these systems, you have to actually deliver the power to get paid. It's not like selling shares in a London Stock Exchange, right? And so normally in most electricity markets that have worked well, you have this sort of liberalisation after the transmission network becomes boring, reliable, well-capitalised, well-maintained. In chunks of Southern Africa, particularly South Africa and Zambia, it's a reaction to transmission constraints to an extent. It's people saying, well, I can't get on the grid. The national utility doesn't want to take my power anymore, so let's try and work around the edges. And that can work when people understand local bits of transmission network very well, where they get security of tenure for their generation projects on the network and they know where the power's going. But if people don't understand that very well, it can work spectacularly badly. So it's almost like a buyer beware or sort of infrastructure builder beware market at the moment. It requires a bit of savvy. There's a lot of risks if people don't understand that to just build and say, I'm on the grid and I'm fine.
So just to understand that's happening at the time of construction. It's not sort of like week to week. I'm told no, there's no capacity this week. You can't move the power. It's at the time you're getting a permit for construction.
So you can clear a wheeling path, don't you? So when you
No. Look, the generators have to go through a process to secure grid access in South Africa, and that's before we kind of get involved with them, right? They've got to apply for the grid, they get a cost estimate letter, then they've got to demonstrate that they've got an off-taker if they want to do this on a private basis, and that allows them to enter the next stage where they firm up that quote, and they've moved from a first come, first served to a first ready, first served model.
Right.
Not without its challenges. It's being inconsistently applied, and there's lots of movement there. But they're moving towards a new framework to try avoid the problems of grid hogging and making sure we're actually getting infrastructure built. Because the timelines to develop transmission are just way longer than the timelines to build a battery storage project or a solar project or a wind project. There's this mismatch there in South Africa.
But there's a related question. So first of all, I think there's a market problem where at the moment you've got lots of stuck generation projects because they thought they'd participate in REAP or something. So you've got a market of people with sunk costs who have done the work already. If that wasn't the case, it's a big risk now in terms of getting the grid access. Then the second step, who is the person you're going to be wheeling your power to, and is there sufficient grid capacity to get the power to them? Now, if the answer to that question is yes, and you get your second permit to sell the power, that's fine. But as an intermediary, you've got shorter contracts, right? So how are you dealing with that risk? If you lose a big user, a big customer that you've got, you want to replace them with someone else, do you know you can get your power to that person, or are you taking a risk on that?
We aren't taking a risk on that, so these are typically back-to-back risks. However, in South Africa, they won't allow. In fact, there's a lot of large behind-the-meter solar projects at mines and whatever that are not being allowed at the moment because it'll change the dynamics of power flows. So that's de facto how the utility is dealing with this. We haven't faced a problem where we can't get energy to a customer. If a customer wants more power, they've got to pay for grid upgrades. If a customer wants to take less power and they want to put solar behind their meter, they've got to pay for grid upgrades. And so de facto, customers are saying, well, we'd love to do this, but actually in the interim, we'll buy power from you until the grid's been strengthened by someone else that allows us to put more stuff behind our meter.
So who is taking the risk then? Is the generator taking the risk because you back-to-backed with your customer?
So they're not taking the risk entirely. Effectively, I mean, we've got a well-developed grid in South Africa, especially around the big load centers. There's not a problem of getting power to people. There's a problem of where can you connect new generation into the grid,
which is remote,
which is remote, and typically at the end of longer lines in the semi-desert parts of the country or along the coast where we don't have a lot of load. It's not the industrial hub of the country. What is a risk is there will be curtailed power sometime over the lifetime of these projects. And so we're having to deal with that on a back-to-back basis, where if projects get curtailed and they don't get compensated by the grid operator for that curtailment, they get an extension of term on our contract, and in turn we can pass on that extension of term to our customers. So we've kind of back-to-back that. But in terms of actual physical delivery, can we get this power to them? Within South Africa, that's not a problem today. I think going into big loads elsewhere on the continent, the transmission and interconnector capacity is very limited, as you said, very, very constrained. But we haven't come up against that particular constraint in SA to date.
Is today the important word?
Yeah, well, to date, it's not. And I think it's the way that Eskom and the grid access unit allows people to connect. Is it
being conservative?
It's very conservative. Right now, I mean, there was basically no more grid connection capacity in the western half of South Africa as of the end of last year. Everything had been allocated to projects. They did a big study with the help of a bunch of European utilities who are obviously facing much higher levels of renewable penetration, and said, well, if you allow 10% curtailment over a year, you can unlock 3 gigawatts of new wind in the western half of your grid, because mostly the wind doesn't blow at the same time the sun's shining. Right. And at the moment, you're treating a project as having capacity allocated to them 24/7, 365, and they've got a 26% capacity factor. They're super inefficient. So they have actually agreed now to do a program to unlock, in the end, it's been about 1,500 megawatts of new wind in the western grid, where that curtailment will be paid out of an ancillary services budget, because it's cheaper than trying to build out new grid to those places, and closes this gap. In 3-5 years' time, they may have strengthened the grid and they won't have to curtail there. So it's seen as a kind of interim measure to socialize that cost. The opportunity cost of not having the power is much greater than curtailing for 10% of the year.
And just to be clear on that, that's curtailing generation.
Generation.
Curtailing
generation.
Right. Let me ask where the money comes from in this. I mean, what is the the DFIs have invested a lot in generation. There's been in Africa in particular. India is changing fairly rapidly. There's still DFI involvement in some things. When do we get to sort of commercial capital in any of the three kind of for each? That's a question for each of you. Not for you. You're already at commercial. You're already at commercial scale.
So if I understand, what is the right point when we get?
Just sort of who's paying for the transmission investments? Where's the capital come from, and how much of it is truly commercial capital versus somewhat concessional, like DFI kind of capital, or other sorts of subsidized, of concessional capital?
Okay, so I think it's different for transmission and battery storage.
Okay.
So for power transmission, I think generally it's led by commercial capital. I'm talking about private players, private developers, and likes of, say, GIC Singapore, KKR, and now BI, Norfund. All these people are coming and trying to invest.
Whereas I don't think of ourselves as commercial capital, by the way, DII. But go ahead.
Yeah, I mean to say private equity point of view. And of course, on the debt side, if I talk about apart from public banks, a lot of interest has been generated by other funds like IFC. They are coming in a big way, big plans. There are a few companies within India who is trying to create a pool of fund through green bond mechanism and various instruments.
Okay.
So those are the typical sources for power transmission. For battery storage, I think it's mix. I think initially when we started battery storage, we got a concessional capital for Global Energy Alliance. And that was really at a cheap rate. It was like a pilot project for Delhi Capital. to establish a use case for battery storage. So that has become India's largest first installation for standalone battery storage. So that was one, and rest is pretty much similar to transmission, what is happening. Of course, government has started now viability gap funding. So that is becoming one of the, at least 1/3 of the capital comes from that side as well. Yeah.
Great.
In Africa, look, I mean, South Africa and Morocco would be different. In those markets, there are local banks and there are sort of infrastructure funds without DFIs behind them who are interested in those markets. The South African transmission tenders that are being organised at the moment, there is DFI involvement, but there is a lot of interest from companies elsewhere in the world, utilities and infrastructure funds as well, on the equity side. All of that said, they are relying on a credit guarantee vehicle that is going to need to be established that will be significantly capitalised with DFI money. So, as I said before, there's always subsidy somewhere in the sector.
Right.
In most of the continent of Africa, the big challenge is that transmission infrastructure is very long asset life infrastructure, and if you want to make it affordable to people, you have to try and amortise the financing costs across a very long period. And only DFIs can provide the sort of tenor to make this infrastructure affordable. So anything we're doing elsewhere in the continent, very significantly DFI funded, but also very significantly funded through grants as well as viability gap funding. So it's a double whammy of concessionary money in that respect.
And that's going to be true for the Mozambique line as well? I mean, that's a big project. So that's going to be, I mean, there's DFI capital, there's grant capital in it, but will there also be sort of is there going to be a pure commercial tranche in a project like that?
The equity returns that are achievable in a project like that could be commercially attractive to an infrastructure fund from financial close onwards. The development risk in getting there wouldn't be.
Right.
But the majority of the funding in that project obviously isn't the equity, it's debt and it's concessionary funding. That will be a mixture of DFI debt, concessionary debt, and grant funding as well. I mean, there will be $75 million plus of straight grant into that project at this stage.
Right. And
Yeah, so I guess on our side, the generation sector in South Africa, while there's still some DFI involvement, I guess in some of the projects, it's very highly geared projects. The terms have got, even on these private sector deals, are very similar what you're getting terms from the bank as on these 20-year government contracts backed by sovereign guarantee, which has been really interesting. So the commercial banks have got quite aggressive and very supportive on the model. For the new business models like ourselves, but there's kind of two categories of player. One of them backed by a big institutional capital or a big corporate, and they're obviously leveraging a balance sheet, so they don't need these guarantees. They've got a parent that says, "Well, we back the idea and the team here." For other players like ourselves, we really needed to come up with an instrument, but from the get-go, it's been a blend of DFI and commercial bank instruments. And we're starting to see even some of the kind of insurers starting to look at the market of can they insure some of this risk, which is happening really quickly, 2 or 3 years into this business model with very few people generating revenue yet. There's a lot of interest in it. So we're seeing commercial capital and kind of risk products both coming into the game pretty quickly.
I think it's fair to say that for us anyway, lack of capital, overall capital to fund an infrastructure project is not a problem at this stage. It could become a constraint. It's not a problem yet. The problem is the lack of projects that are ready to be funded. So project development is the big gap. It's the big gap.
And when you say project, so that it is the project development phase of that. It's not that you don't know where the line needs to go. It's that there's a lot of work to get from that point to where you actually have a financeable project.
Every country in Africa has a detailed transmission development plan. International consultants have created it. Those utilities know exactly what the priorities are. They just can't get them turned into a financeable project.
Interesting. We've got about 10 minutes left. Let me open it up and see if anyone has any questions from the...
Hi, thank you. I have a question
Wait, let's get the mic.
Hello, I have a question for Energrid. So you mentioned a few international institutional and large asset managers who are interested in the transmission sector in India. And I hear that a lot amongst international institutional investors like pension funds who look to the standardized tender process as a reason why they're interested in participating in the Indian market. My question is around domestic capital and domestic institutional investors. Are you seeing growing interest in that sector?
Yeah, of course, because as he said, same pattern, commercial banks are available, large PSU banks and couple of private banks are already interested. There are a lot of NBFCs as well. They have been kind of sitting with a lot of corpus of funds and ready to invest for such infrastructure projects. Typically in India, we talk about 75-25 leverage. So 75 generally largely is coming from commercial banks.
Thank you.
Yeah.
I wanted to ask about something that we discussed a little bit last night, which was that Reuters story about underbidding on batteries in India. So Reuters ran a story saying that there are contracts being awarded at prices which nobody believes are deliverable. So I'd just like to hear how you think that's going to play out.
Yeah, that's very interesting. Actually, so this all started 3 years before when India just, kind of got into battery storage. I'm talking about LFP, lithium ion chemistry. So 3 years before, I think the tariff was at around 14-15 cents. And we were the first one to bought it to 6 cents in the span of 2 years. And today it's even below 2 cents. So that's a dramatic reduction happened. But what we believe, I think looking at the complexity of the solution, it's a true engineering solution with a very active chemistry involved. And if somebody has to really look at not to compromise ESG element, largely with safety, reliability and performance, the current tariffs are not at all sustainable. That's what we believe. And so as a framework, we are very selective about the project which to opt for. And accordingly, we make our investment decisions. But on the tariff side, I think of late we are seeing like 2 cents below is totally not viable because the solution cost itself will not fit into that tariff. So to our opinion, I think viable tariffs are around 6 to 7 cents. That is the viable number. What we generally look at, probably now industry will go through some consolidation. People will realize that it's not only picking up the project, but they have to execute as well. And I'm very proud to share that when we won our couple of bids like 12 months before, there were 4-5 other developers. We are the only one who has hit the ground. So nobody else even could able to close the financial closure and even order their batteries at such levels. So probably time will tell, another 6 months to 12 months, and the tariff should correct back to sustainable levels.
And just to comment on this more broadly, I think you need some kind of way for reputation or past performance to feed back in. And it's very delicate to get that right. If you squeeze too tight and you make the RFQ, okay, you must have built 50 projects of this capacity at this scale, and you must have financing at this rate and so forth, then you've shrunk the market and you'll get very high prices. If you want high prices, you can shrink it enough and get high prices. If you're too lax, then maybe there's some non-performance, but probably in the early going, it's better to be too lax and let things sort themselves out so that the buyer bears the risk of non-delivery and they learn their lesson in the future, so long as the procurement mechanism is flexible enough for that to happen. And this phenomenon is not unique to renewables. Mm-hmm. This underbidding has happened before. In India, it happened for coal-fired power plants. Many plants basically were bid under competitive tenders, and some of them were obtained to build those plants, the contracts, at extremely low prices that didn't reflect the future volatility in the price of coal. And then the companies would come back after some time and say, look, I know we promised to build at, say 3 rupees. It's not viable anymore. What can you do? The difficult thing is at that point when the company comes back, it's no longer a competitive tender because they've got a half-built plant. And so the government's in a very poor position to revise or say what the price should have been. So you want a contract that is predictable enough. And the good thing about these battery storage systems or about renewable generation plants, unlike the coal plant, is all the capital cost, basically all the cost is up front. So you've built it, you perform or you don't, and then you get out of the way. Whereas the thermal plant, it's almost an ongoing relationship if they're also going to manage that going forward.
Great. We're just about at time. This has been a fantastic, really fascinating discussion. And thanks to all the panelists and thanks to you all as well. So
Thank you.